Brad Williams, Frugal Finance. Let's discuss credit cards, a subject that just frustrates the living daylights out of me because the credit card companies are crooks. And there is just an unlimited amount of data that supports their crookedness, for lack of any better term. Credit card interest rate margins at an all-time high. Yeah. You know, that interest rate that you're not aware of, you just keep paying that interest as Visa, MasterCard, etc. continue to rob you of your hard-earned money. By some measures, credit cards have never been this expensive. Cardholders who carry a balance without paying it off in full each month, issuers generally charge interest based on an annual percentage rate. In 2022 alone, credit card companies charged over $105 billion in interest. Here's a crazy little fact. There's over $1 trillion in credit card debt outstanding right now. 45% of credit card holders pay off their credit cards monthly. In other words, they're not paying this $105 billion in interest, leaving 55% of you carrying this burden, this huge burden. You're working your butt off, but guess what? Credit card companies are making a friggin' fortune in doing really not a whole heck of a lot. I thought Microsoft had a huge markup in terms of their profitability. If you separate, and I'm speculating here because I haven't broken out the number, but if you look at credit card companies' charge-off rate versus their profitability, and I'll report on this. There's a return on assets, return on income, but this $105 billion, all it takes is some keen software and some due diligence on the part of the credit card companies. It doesn't take a lot of effort. And they're just reaping huge benefits while you're just sweating, busting your butt. Another fact is 55% of people who have an outstanding balance on their credit card, it's about $5,000. Now, this margin we're talking about, it's up to 22%. 22.8% on $5,000. Just take your $5,000, multiply that times 0.228, and you're going to find out real quick that you are spending way too much money on credit cards. I know, you find yourself in a burden. You find yourself forced to repair a car, forced to buy groceries. I get it. But again, this is frugal finance. There are ways to cut back. There are ways to get this 22.8% down. And I'll discuss that. Credit card average APR is the highest on record. Over the last 10 years, average APR, here's your APR. You have a index. You're usually going to use prime rate. And right now it's, I guess, probably 4.5%. Then you have this 22.8%. You have the compounding effect, which is on a daily basis. So that spread differential will crank out your APR. So in other words, the credit card company's going to go, well, your credit card rate is 18%. But then you add, well, let's go 20%. Then you have a compounding effect, which bumps it up. I don't think it's 2%, but you get the idea. This compounding, and I've discussed this time and time again, if it's on a daily basis, you're being taken to the cleaners. So here we go. From 10 years ago, this rate was 12.9%, this spread. Today, look at it's increased to 22.8%, the highest level record since the Federal Reserve began collecting this data in 1994. Shameful. The friggin' greed, the greed. The APR on most credit card accounts can be viewed as being composed of the prime rate and the APR margin. This APR margin, this is what's set by the credit card company, the big banks. The prime rate, a benchmark most banks use to set rates, represents a good proxy for banks' funding costs. So here, this is what kills me. The banks can go in and they can borrow at the Fed funds rate. What is that? That's that super low rate. You always hear, well, interest rates drop to 3.5%. Well, banks can borrow on a daily basis, and they do. The Federal Reserve allows them to borrow at that rate. Then you have a prime rate. That is what banks will pay. If you give them 10 grand, they'll pay you a CD rate, which it could be the prime rate. It's generally lower because they have to shave off a ton. Subsequently, if they're borrowing at 3.5%, or let's say the prime rate's at 5%, they're making that spread. That's why they can go in and say, well, we have this promotional deal. We're going to give you 2% back on your purchases. Really? All they're doing is robbing Peter to pay Paul. You see this 22.8%? Notice, look at this. This is just Notice how these promotional deals get better in exchange for this margin increasing. Well, the banks, they have analysts. That's what they do all day long. They analyze and they go, well, if we offer them 5.5% back, all we have to do is bump up this margin 0.25% and subsequently try to ring them in. We're going to get them one way or another. They're giving you a 5.5% promo, but they're making it up somewhere else. It's you as a consumer. I'm going to interject here. Stop spending. Really. It's just that simple. I know. We're in a world where consumerism is key, and you see the crap on TikTok and kids going out and spending a fortune on cosmetics or shoes or sunglasses or anything to be cool. Well, that starts the trend, and then you want to keep up with the Joneses, so you just keep buying crap, and then you go over to Temu. So again, let's thank the Chinese for all the shit they keep selling us and the consumer that keeps buying it. Yeah, here it is, the beginning of January, and at one point in this month, TikTok was shut down for a minute, and I think it should be shut down permanently. I think it's just a pathetic app. And then the same with all this crap being sold from China. And now you have a new app from Amazon, which is called what? Haul, which is competitive with Temu and what's the other one? Stein or whatever, Shine. Look, I'm guilty. I buy throwaway crap from Temu. Well, and it's throwaway. It's just consumer crap that when I'm doing home repairs, sandpaper, I can go over to Home Depot and spend a fortune, or I can just buy the same thing from Temu. I'm going to throw it away anyway. I use my credit card because you have to, but I always pay it off. So the moral of the story is manage your spending. Now, back to the subject on hand. Look at this, 2013, this spread, 12.9%. That means if you look at the prime rate, I don't know what the prime rate in 2013 is, probably the national average is about 4.5%. We'll just use that and just add 12.9 and you're going to see, oh, I'm sorry, if I would read, here's the prime rate, 3.3%. And then you could see how it correlates. I don't get why. Why? Because the prime rate goes up. Here we have this margin. Again, gotta love Wall Street. Yeah, that's crooks. Now, the only reason I say crooks is because you, as a consumer, have control over this. And if I can't stress enough, budget. And I know you like that endorphin high when you go out and buy stuff. Or for men, you like to brag about that boat or your freaking golf clubs or what have you, your new truck. Look, I can't tell you what to do, but if you want to retire comfortably, if you want cash flow, think about, look, you think at 22.8%, there aren't these fat asses sitting on a yacht somewhere that figured this out long ago? Look, I'm going to sit comfortably. Thank you very much for paying this 22.8% while I'm, hanging out with my other billionaire friends. So turn around. Take your hard-earned money, invest it, and then in 30 years, you may be sitting on your yacht. Higher APR margins have fueled the profitability of revolving balances. Yeah, typically card issuers set an APR margin to generate a profit. That is at least commensurate with the risk of lending money to consumers. Now that's fair. If you're high risk, you should pay a higher interest rate. It's just simple math. In the 8 years after the Great Recession, the average APR margin stayed around 10%. As issuers adopted to reforms in the Credit Card Accountability, Responsibility, and Disclosure Act of 2009. Look at this. See, we have to impose all of this legal requirements. Otherwise, the crooks are just going to get more crooked. Why? Well, because they just have unlimited back-end and hidden pricing practices. I will report on all of this stuff just because I loathe credit cards. And there's a lot of research. Again, this is from CFPB, and I don't know if they'll be around after the end of this month, but if they are, I say thumbs up, but I suspect their funding will be cut dramatically, and subsequently we won't get this great reporting. Over the past decade, card issuers increased APR margins despite lower charge-off rates. Okay, here's the charge-off rate. People will run up their credit cards and then go, well, I can either BK or I can just walk away. And it happens all the time. But look at this. You can see on average, we're looking at probably, about, I think it was about 6% forever on average. You can see 6. And then we had the meltdown. Then we had the pandemic, so on and so forth. So you have a charge-off of about 3.5% from 6. So lower charge-off, higher margins. Shameful. Look at this. And the average margin, it's just gone up. And the charge-off rate is going down. Yeah. Excess APR margins cost consumers billions of dollars a year. Yeah. In 2023, major card issuers with around 500 billion in revolving balances. This number has increased that much in a few years, okay? 590, they reported revolving credit card debt to be $1 trillion. Now, that might just be combined with something else, but I just was reading that. I can't imagine credit card debt doubling literally over a year's period, but I will look into it. Anyway, with that 590 billion, can you imagine 590 billion at 25% interest, or 22.9? Wow. Because of these excess margins, charge an estimated 25 billion in additional interest fees by raising the APR by 4.3% over the last 10 years. That's just the 4.3%. For an average consumer with a $5,300 balance across the credit card, the excess APR margin costs them over 250, but that's not even including. Again, what I said is if you take your 5,300 times 22.8 is going to be what? Isn't that shameful? You're working your butt off, you have $5,300 balance, and you keep it at that balance, and you just pay the interest. Well, $1,200 a year. $1,200 a year. That's just interest. You're not paying off that principal. Now you can see why I'm just so vocal about managing this. Keep in mind, that's only 55% of the people out there have a credit card balance. I don't know how many have a balance significantly higher, but 45% pay that off on a monthly basis. So they're not stuck with this. You're making a lot of people really, really rich when you're part of this $1 trillion group. The increase in APR margin has occurred across all credit tiers. Even consumers with the highest credit scores are incurring higher costs. The average APR margin for accounts with credit scores 800 or above grew 1.6% from 2015 to 2022. Okay, now, if you haven't got the tone of my videos, it's all about your credit score. Even though you have crazy balances, if you're not in that 720 range in terms of this credit score, that's your first problem. You need to not only manage your credit cards, but you also have to manage your liability. In other words, you need to pay on time. You need to go and check your credit report and make sure if there are any errors, correct those errors. You need to, if you have a pocket full of credit cards, you need to get rid of all but maybe a few. And yeah, people are going, well, you can't close out credit cards without damage. Well, you're already damaged. So take an intermediate step and stop putting Band-Aids on you get the idea. Manage your credit cards. Credit card interest rates are a core driver of profits. Well, no kidding. If you're making an 18% margin, that's just pure profit going to the house after all your expenses. Credit card issues are reliant on revenue from interest charged to borrowers who revolve on their balances to drive overall profits as reflected in increased APRs. Return on assets on general purpose cards, one measure of profitability, was higher in 22 at 5.9% than in 2019 at 4.5%. Now, I don't know if they're looking at the entire banking sector. In other words, you have this big pool of money coming in from a whole bunch of different sources. And if they're looking at the return on assets, which is really not a very good measure, but you get the idea, they're making a lot of money. And the bottom line here is, you need to put in place very, very strict spending control. That's it. Babysit your credit cards, take care of your credit score, and that's 90% of the battle. Let me know. You're going, Williams, you preach too much. Well, maybe I do. It's just painful when I read this stuff and I know so many people are struggling going, well, how about we say thumbs down to the billionaires and make you one of those billionaires? Brad Williams, Frugal Finance. Thanks for watching.